Welcome to the Wealth Under Pressure podcast. Financial success very often has less to do with owning a financial product, earning a high income, or even being frugal. Instead, the path to success comes from having a comprehensive plan that enables you to optimize decisions and avoid mistakes. Join John Smallwood, a certified financial planner, as he identifies key areas of pressure on people's wealth and strategizes to reduce it. It's time to liberate your wealth.
Hello and welcome to episode number 8 with John Smallwood. Today's podcast is, do you suffer from QBI? Okay, John, you got me, man. What in the heck is QBI?
First of all, I just want to say I sure hope you do.
All right, well, that's fair. I guess I hope I do too, but when somebody asks me if I'm suffering from something, usually I want to get it cured. So tell us what this is.
There's a brand new acronym that we all have to put into our vocabulary, which is qualified business income.
Okay.
Under the new tax law, there's the pass-through entity that we're all talking about, that we're all the lower tax rates. Are we going to benefit from this? It's super complex. I can't tell you how many hours I spent reviewing, reading, rereading, rethinking, reading articles saying, oh, that's not right, this is not right. I don't think it's really a tax simplification act for a small business. I think it just got a lot more complex. And as we unfold today's conversation, the business entity that you have is going to be crucial in your ability to take advantage of the 20% business deduction that everybody's talking about, okay? The 20% of the qualified business income as a deduction on your 2018 and beyond tax return.
Okay.
So we have to start with, what the heck is QBI? Like, what is it? What is a qualified business income or trade is what it comes down to, okay? So you got qualified business trade, qualified business income. And the way it's defined in the new tax law is anything other than the following things. Okay. So
Okay.
So I want to start with the dirty list of, it's a trade or business performing services other than as an employee. Okay. So if you're a business performing services to other businesses as an employee per se, you're not going to qualify for it. If you're one of the specified service or trade businesses, you potentially do not qualify for qualified business income. The list is a long list. It's healthcare, law, accounting, actuarial science, performing arts, investment management, partnership income, consulting, athletes, again, financial services, brokerage services, and this is the one that I really love. Any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees. Isn't that any business?
That seems rather broad and indescriptive.
Right, like, how do you define that?
Wow, what the heck?
Right? So as you sit here, you think about it, it's this, you have to determine, does your business fit into one of the specified exclusions, for lack of a better word, okay? And where's your income? And this is really going to be the powerful side of this thing, is understanding the nature of your personal tax return. And what's going to be interesting is, and this is some of the things that as we go forward into 2018, we're going to be developing this a little bit further. But let's say you own a business and your spouse has a great job working for, a big company and commands salary and bonus, and your partner doesn't have that. Your partner may be able to take advantage of the QBI, but because your spouse, which is a good news, is really successful, you can't take advantage of QBI because your tax return, married filing jointly, is now substantially higher. Okay. And I don't know if, filing separately is going to be the way out. And this is why it's going to be really important to get with your tax professionals and really dissect, look at Matt's makeup, look at the individual makeup and understand who am I, okay?
Okay, I'm going to pause you. John, hold on a second. So help me do a conversion here. So who is this for? LLCs, S corps? Is it for? I'm sorry. I feel like you're farther down the road than I am, and maybe that's just because I'm slow this morning. And I'm sorry if I am, but help me with that a little bit. Do you mind kind of regressing a tad and saying, okay, if you are this is potentially how it changes?
Yes.
Okay.
So
thank you.
If you are a sole proprietor,
okay,
basically filing Schedule C on your tax return,
mm-hmm.
you have a pass-through entity.
Yes. If
you are an LLC, whether you're passing that through as an S corp type taxation or the LLC taxation, you are a pass-through entity. If you are a partnership, you are a pass-through entity. If you are an S corporation, you are a pass-through entity. Basically, anything that ends up on line 17 of the tax return. Okay.
Much clearer. Okay. Now, okay, continue.
All right. So, and I have a tendency to, I'm thinking at the highest level, and I need to bring it down to simplistic.
Well, you're a pro at this, John. I mean, that's what my job is here is to, I'm supposed to, and I am the normal everyday Joe Schmuck walking down the street. So that's why I wanted to ask you that question. So, okay. So now I understand where we're at.
So now you're a pass-through entity. You have a business entity. You're a Schedule C. You're an LLC. You're an S corporation. You're a partnership. You're some sort of company not working. You're not working for somebody getting a W-2. You work for yourself. You own a company. Now, what's interesting is I gave you the dirty list of the specified other than. So basically, qualified business income, QBI, is any trade or business other than a trade or business performing services as an employee or the specified list that we just went through, right? And that specified list is that the exception to the specified list, and this is something that I didn't really understand early on in reading it, and I thought if you're on the specified trade or business list, if you're an attorney, you're an accountant, you're a financial services advisor, you're some sort of, you're an actuary, you're a consultant, you automatically were thrown out of this because you were on that, what I was considering to be the dirty list, okay, of people who were excluded. Mm-hmm. But the exception basically says, exception for specified service trade, so the business or service, if in any year taxable income is less than the threshold amount of $315,000 for a married filing joint plus $100,000, so $415,000, or $157,000 for a single taxpayer plus $50,000, you're going to benefit from this QBI. Okay, and it literally says, then shall not fail to be treated as QBI. If you are earning over that, you fail. The good news is you're successful and you're really successful. You didn't fail, but on the tax code, you failed.
Okay.
I want to be clear with that, okay? So when you start thinking about this is going to be really interesting. So the big part of this law is that there's a 20% deduction for qualified business income, or the lesser. Now, when you look at this, it's the lesser of 20% of the business income or 50% of the W-2 wages paid by the business. And then there's a very complex calculation that says 25% of W-2 wages paid plus unadjusted basis of property assets. So you have a company that has lots of assets in it. The basis, the unadjusted, the undepreciated assets calculation. We're going to stay away from that because that's super complex. Okay.
All right.
But so if you think about this for a second, let's say you're a sole proprietor. Let's put this in mathematical terms for a second. Okay.
Okay.
you're a sole proprietor, Schedule C on your tax return, and you have business income of $500,000.
Okay.
So if you're doing the calculation, 20% deduction for QBI is the lesser of these two calculations. So the first calculation says, well, I can deduct 20% of QBI. My QBI is $500,000. That's my qualified business income because I fit in here. So I'm thinking I can deduct $100,000 and only pay tax on $400,000 as opposed to paying tax on $500,000. But the calculation is the lesser of the two. The second piece in this is 50% of W-2 wages paid by the business. Schedule C doesn't pay W-2 wages.
Right.
So that calculation is zero.
Are people going to want to move to S Corps then so that it is a W-2 pass-through entity instead of an LLC? Or is that too overarching of a question?
It's a possibility because, and I don't think this was the spirit of the law. I don't think this is what was intended. Okay. So I think, things, as in always with everything that ever happens when you push a bunch of stuff through, when you push it through a fast, easy process, there's unintended consequences that come out. Those unintended consequences are what we're trying to understand. But if you compare this, so let's say you're an S corporation, same $500,000 worth of income. You paid yourself a salary of $125,000.
Mm-hmm.
So now the qualified business income is $375,000. If I take the 20% of $375,000, that's $75,000. Or 50% of my W-2 wages of the $125,000, that's $625,000.
Mm-hmm.
So I got to take the lesser of these two.
Okay.
So technically, as an S corporation, paying myself a salary of $125,000, I get to deduct $62,500. I get the deduction of $62,500 under the qualified business income.
Mm.
That's crazy, right?
Yeah.
And now a partnership, if I have a partnership and I pay myself what's considered a guaranteed payment, which is what people do in a partnership, that same exact $500,000 gross income, I pay myself $125,000 of guaranteed payment. My QBI, get that term down, QBI, is $375,000. My tentative deduction is 20% of that. There are no W-2 wages. I get zero deduction.
Okay, I'm not trying to get political here, but wasn't this supposed to be like small business friendly? What am I missing? I'm sorry, John. What am I missing? I'm sorry. I feel I'm hearing what you're saying. I'm taking notes. How do we, because I'm a small business owner just like you, right? How is this beneficial to us? How is this going to help me hire people? How is this going to make me put more money into my company and stuff?
Right. So now the math comes down to, if you're an S corporation, you probably have other employees. Mm-hmm. You probably have W-2 wages. You most likely have people that you're paying. All right. So this is why I keep coming back to, it's like, oh, wow, this was so exciting. 21% tax bracket, but we're not going to get that either. So we're going to talk about that in a second. But then I looked at it and said, all these different business entities, if you read the spirit of the law, the way you choose your entity becomes super, super important. And the way you rethink your entity becomes super important. So now, as I read through this, and this is where this opens up a tremendous need for reviewing where you are and what you're doing, is that their QBI does not include the concept of reasonable compensation or guaranteed payments. Okay, so the W-2 wages of reasonable compensation, and this is where it gets really confusing, and I haven't really narrowed down a consistent answer with the tax professionals that I've discussed this with, is what is reasonable compensation? And as an S corporation, for years, we have been recommending that people pay themselves a reasonable salary.
Yep.
And then above that level, take everything out as an S corporation and as an S distribution. Because what that did is on every $100,000 of profit in the company, you would avoid the Medicare tax. Reasonable compensation, if we were talking to an S corporation owner, you'd want to have a reasonable salary. So if you were a business owner making $500,000 as an S corporation and you're paying yourself $500,000 in salary, you were paying Medicare tax on all of that money. If you paid yourself a $200,000 salary and took $300,000 out as S corporation distribution, you were avoiding the 3.15 or so on that $300,000, which is about $9,200, $9,300 worth of savings, about $3,100 per 100,000, right? So it was simple recommendation: pay yourself a salary, and that reasonable compensation is a tremendous argument. Okay, and there was no definitive source to say what was reasonable compensation. So you'd see people paying themselves the maximum amount for a pension. You'd see people paying themselves $100,000. You'd see people paying themselves $300,000 to be reasonable. And then the rest of their profits were coming out as S corporation distributions.
That's what my accountant told me to do. Absolutely.
Right. And it's smart. It's smart. And the IRS is onto it and they get it, but it's still part of the tax law. Okay. So it's still reasonable. In this law, there's a whole subsection that talks about reasonable compensation. It doesn't define it, but reasonable compensation for S corporations is going to become extremely important in 2018 and beyond. Okay? But what they're saying is qualified business income does not include reasonable compensation and guaranteed payments. So when you start looking at that W-2 wages, I'm the S corp, I pay myself the $500. I made $500,000 in business income. I paid myself $125. If that's, to me, is that reasonable compensation, and is that technically excluded? And I don't have a clear answer on it.
Okay.
Mm-hmm. I don't have a clear answer on it, and we're trying to get to it, but nobody knows that definitively. It's all we're going to see. We're going to see.
Okay.
Okay. So now what's really interesting is go back to the dirty, excluded service and trades. QBI is any trade or business other than the specified trade or business list. Okay.
Mm-hmm.
Regardless of your business type, if your income is below the threshold amount of 315 plus 100,000, you will get the 20% of business income deduction.
Okay.
All right. So I have a sole proprietorship earning, we're going to bring the numbers down now, right? We're going to bring it down to $200,000. So everything's going to be $200,000. Sole proprietor, Schedule C, making $200,000. The 20% of that is $40,000. The deduction is going to be $40,000. So instead of paying tax on $200,000, it looks like you're going to pay tax on $160,000 of that income. If you're below the 315 plus 100 married filing joint. So every business, regardless of the type of business, if your profit's below, it looks like 315 and 100 married filing joint, you're going to benefit from the 20% deduction. And that hits a tremendous amount of businesses. Right? I mean, this is huge. So the question before is, should I run out and be an LLC? Not so sure yet, right? Depends on you and your business income. So if I'm sitting here looking at the sole proprietor, I get the QBI, I'm paying tax on the 160, and this is a misconception that I'm hearing also, which is it an itemized deduction or is it a straight reduction from the income? And it's a straight reduction from the income. So if I have qualified business income of $200,000, I get 20% of that. It's $40,000. I'm paying tax on the 160. Now the S corp version of this is where it gets crazy. $200,000 business income, $80,000 W-2, $80,000 salary. The net income is $120,000. 20% of $120,000, $24,000. I'm only getting the deduction for $24,000 because the business is below. I don't qualify for 50% of the W-2 wages. The way you read the law, right? So I should get the lesser of, because it comes down to the lesser of, right? $24,000, but because the W-2 wages were 80, that's 40, I'm only getting 24. So now I'm getting a deduction of 24, not for 40. So now the sole proprietor wins.
Okay, hold on a second. I need to pause and just everything that you're talking about right now should probably be a joint conversation between you, our listeners, and their accountant or CPA. Is that a fair statement?
100%.
100%. So all of the numbers that you're talking about right now are I mean, they're written into the law, but they're projected numbers. And so, we just need to make sure that our audience knows that this is the beginning of a conversation, and it's a very vital conversation that you have with a professional like John and your CPA. Fair?
Very fair.
Okay. Now, I'm going to have you put on your Karnak the Magnificent hat, which, of course, I'm sure most of our listeners have no idea who that is, which is an old Johnny Carson routine where he would pretend that he would know the future. So I'm going to ask you to know the future here, Johnny. Ready?
Yes.
When is all of this going to be figured out, man? I mean, are we looking at by the end of the year, by April 15th, by 2048? I mean, how long? So you've been around. I'm asking you this because you've been around for a little bit, right? You've been existing in the, 1986 tax law? Isn't that the last major tax law change?
Yes.
Okay.
Well, yeah. Many different ones along the way, but yes.
That was the major one. Do you know historically how long it took for that 86 major tax law change to be streamlined, understood? I mean, what is our time frame here, man? Because this just seems, especially from a small business owner perspective, this is a huge paradigm shift. This is oh my gosh, did I set up my organization correctly? This is, oh my gosh, I can't write off some of the things that I thought I was going to be able to write off. And that's what's freaking me about QBI and all of these other things. I'm going to lose an enormous amount of deductions, which was a good thing probably, right? Because I'm sure a lot of small businesses run stuff through their business that probably shouldn't be run through their business. But when do you think?
Never.
Okay. That's fair. That was quick too. That was a great answer. I was rambling there. You're like, never. Yeah, screw it, dude. All right.
No. So if I had, I tell a story where my grandmother, when I started in the business in early, 1990, my grandmother gave me a crystal ball, and day one, I had this crystal ball on my desk, and I turned around and accidentally knocked it off the desk, and it shattered into a million pieces.
Oh, no.
So I lost my crystal ball. But think about what's happening right now. Most of the accountants are gearing up for 2017 tax returns.
Yes.
So everything's on the old law. And now so everybody's going to be focused on old law, all the financial planning softwares, everything that I've seen that's out there. Nothing's been updated yet because it's super complex.
Right.
All right. So I don't think we really know what happens. So if you think about this, they will find this out. They'll finish doing the tax returns. The software and everything should be updated as, April, February, March, April. Then you'll start running the projections through new software to figure out what's going to happen. Mm-hmm. And I think you're going to see I think you're going to see small changes to this because I don't think the unintended consequences was to treat a sole proprietor, an S corp, and a partnership differently. I don't think that was the intent. I think the intent was to provide everybody with the same type of pass-through entity, but I could be wrong. But on a bigger picture, if you're benefiting from the QBI deduction and you're a manufacturing business and you're a trucking company, you're a transportation company, you're a distribution center, you're whatever, you're that kind of a business, and you're benefiting from this QBI, it's very interesting because you're getting that deduction of the 20% or your W-2, 50% of your W-2 wages. There's a lot of add backs, and the add backs, adding back depreciation and things like that I've seen. There's a lot of add backs. We'll get to that in a separate podcast. I don't want to make this overwhelming. It's already overwhelming. I don't want to make it more overwhelming. But what's interesting is if you were getting taxed, let's just say on $500,000 before, and now you're getting taxed at 500 less 62.5, and then under the old bracket, that would bring you down to 425, and then you were getting a state and local SALT deduction, and now you're only getting $10,000 of property taxes, but you're still getting your mortgage interest, and now you're getting a higher exemption amount of $24,000 for the family on the tax return. Who knows where that income is? But under the old tax law, when your income crossed over $153,000, that was being taxed at 28%. The new tax law at 165, and I'm talking married filing joint, okay, you're still only being taxed at 24%. So exposing less income to tax with this QBI deduction and paying a lesser bracket really has the effect of getting close to that 21% corporate tax. And there's a lot of people that are upset that, hey, I'm going to pay a higher tax, but I think your effective tax bracket goes down dramatically. This is exciting, but I think at the end of the day, a lot of people end up saving a lot more money than they thought they were going to save. Because most people believe they're not going to save anything because of SALT.
Gotcha.
And I really believe even a W-2 earners, this is a QBI conversation, but even W-2 earners who work for a corporation, even in the high SALT states, are still going to save taxes under this tax law. Absolutely. So let's kind of just jump back here for a second. So, we started off with, do you suffer from QBI, right?
Yep.
I think you really want to have QBI. This is one of those things that you really want to have, and you really want to understand is, where's the income coming from? How do if I'm Schedule C or a partnership, how do I benefit from my entity? Do I have the right entity with the level of income that I'm receiving? And again, entities are really, really important. So you have to dig in here and say, well, why do I have an S corp versus an LLC versus a sole proprietor? And 9 times out of 10, it's for corporate liability.
Yes.
Right? But how you treat your business and how you do a lot of things in your business is also important to that corporate liability aspect as well. If you're keeping good books, which most business owners don't keep good books, they don't keep their minutes up to date, they don't do those things, your corporate veils can be pierced anyway, because you're not keeping it like a corporation, you're keeping it more like a Schedule C. And we see this all the time. Okay.
Mm-hmm.
So my point of this is that are you going to have QBI? If so, am I one of these businesses that's one of these specified trader services businesses? Yes. If yes, is my income above or below the threshold amount of that 315 plus 100? If it's below, my entity choice is going to be really important, right? Because I'm going to be able to benefit from that 20% deduction. Right. Yep. And a lot of people, and I want to say that, I really want to emphasize that. A lot of people are going to benefit from this. Okay. But if your spouse happens to be a super high earner and you've got a great business where you're bringing in $200,000, but your spouse happens to make $300,000, $400,000, $500,000, it might throw you out of that in those other thresholds as well. So, hey, my business is making $200,000, I'm going to benefit from this QBI, but your spouse makes $500,000. Now your total adjusted gross income is now above that 415. You're now back to the old rules that we were talking about, and as that sole proprietor, you're not getting any QBI.
Gotcha.
All right. So, I always like to joke is that when you throw a rock into a pond, you get a ripple effect. And those ripples will go all the way across the pond and touch every aspect of the pond, and they'll have different impacts across that entire pond. There'll be erosion, there'll be all kinds of things, right? Mm-hmm. In your financial plan, this is a new rock thrown into your pond, and it's going to ripple through your financial strategy in many, many ways. So what I want to do is I want to get everybody's – I've always been a big fan of, we'll pay our tax – we'll file our tax returns when we're good and ready. I want to get these books up to speed. I want to know right now what my QBI looks like in a 2017 world, and what changes can I make right now in January, February of 2018, so that when I get to the end of the year, I could benefit from QBI and offset my SALT and do all these things that are out here. So these are two terms that in my 27 years of doing this, SALT and QBI I'd never heard of. SALT, we knew it was state and local taxes, but I never called it SALT ever in my entire life until about December.
Yeah.
Right? So these are two new terms that we really need to grasp. And then we need to really grasp what is reasonable compensation, because I think reasonable compensation is going to become a huge factor in this piece, because if reasonable compensation is excluded from the QBI calculation, it's not included, that reasonable compensation is going to affect your profit. And if you say, I pay myself $50,000, but a reasonable compensation comes back and says I should have paid myself $250,000, that's a completely different calculation.
Yeah.
All right. So it finally becomes something that I think is extremely powerful. So my point of this whole thing is, do you have QBI? Okay, yes. If so, are you above or below the threshold of that 415 married filing jointly? If you're below the threshold, the entity, sole proprietor, S Corp, LLC, acting like an S Corp, et cetera, the partnership, very important to understand how you're going to benefit from that. Two, if you're not one of the specified excluded trades or businesses, how are you going to benefit from this? And I think it's pretty substantial. It's unless you fall into that last category of any trade or business where the principal asset of such trade or business is the reputation and skill of its one or more employees. I mean, how many businesses out there do you see? You got a star salesman who brings in 75% of the revenues to the company.
Yeah.
If that guy leaves and goes to another company, 75, 90% of those sales go to that new company.
Right.
I don't know how that's going to play out. So, crystal ball, Karnak, the future, I'm not really sure who's going to be included in QBI when you factor all of these things, how well it's going to be policed. But I really think if I had to list the 5 actions that I wanted to take, right now, is look at 2017. Get your 2017 books up to a really good, get them as clean as you possibly can, and understand, okay, I grossed this, I had all these expenses, or what expenses on that list are going to be add backs to the QBI, such as certain levels of depreciation, my reasonable compensation, and identify what these add backs are. Then understand what do I qualify for the 20% or the 50% of W-2, or does my business have a tremendous amount of assets like trucks and equipment that I now fall into that 25% and 2.5% calculation that I alluded to earlier, and then run a simulation on your 17 versus your 18. And I hope within the next couple of weeks there'll be software that you can do a comparison or something like that, but we'll see.
Okay.
And then the final thing is set an action plan and start making the changes ASAP, so that you benefit from the SALT. Not SALT, from the QBI.
Right.
I can't even get it straight.
So we are going to continue to do podcasts on this. So I want everybody to understand that this is, hey, lots of stuff has changed. Here's how those changes, we're viewing them right now. But John and I will be continuing to flesh these out as 2018 and in future years continue to clarify aspects of this new tax law. With that, John, what else you got for us? Anything else?
So I have nothing else to add to this at this point, but the fact that if you don't have an advisor that you're working with that you're confident with or that you feel that you can talk to, our door is open. You can go on our website, smallwoodassociates.com, request an appointment, and set up an appointment with us, and we'll help you understand where you are and help you make the decisions and work with your tax professionals to implement the right structure.
Fantastic. If you have not subscribed to the podcast yet, please make sure that you subscribe below. There is going to be a lot of conversation surrounding what John talked about today. And if you are a business owner, this is your podcast. What we talk about on this podcast with John Smallwood, every time we do a podcast, pertains to people who are business owners. That is one of his specialties. As you could tell today, he knows an enormous amount about it. So subscribe to the podcast. That way, every time John comes up with a new podcast, it'll show up directly on your listening device. For John Smallwood, I'm Matt Halloran. Thank you very much, and we'll see you on the other side of the mic very soon.
Smallwood Wealth Management is a registered investment advisor. The opinions expressed by Smallwood Wealth Management and guests on this show are their own. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only. Moreover, no listener should assume that any discussions or information presented serves as the receipt of or a substitute for personalized advice from Smallwood Wealth Management or from any other investment professional and is not intended as an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Smallwood Wealth Management is not a law firm or accounting firm, and no portion of this presentation should be interpreted as legal, accounting, or tax advice. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation.